Hello, I'm Connecticut State Senator Matt Lesser, co-chair of the Insurance and Real Estate Committee. Today, we're going to hear from a panel of experts about climate change initiatives on the state and federal legislative front. Here with me today is Katie Dykes, the Commissioner of Connecticut's Department of Energy and Environmental Protection, or DEEP. Katie previously served as chair of the Connecticut Public Utilities Regulatory Authority, PURA, from 2015 to 2018. And as Deputy Commissioner for Energy at Connecticut DEEP from 2012 to 2015. Katie?
Well, thank you so much, Senator Lesser. It's really great to be part of this exciting panel. And I want to thank you for all of your leadership that you've been providing in the legislature on our insurance regulation and ensuring that we have some nation-leading frameworks here in the state of Connecticut. I also want to thank Commissioner Andy Mays for his leadership in convening this summit. Commissioner Mays and I both serve on the Governor's Council on Climate Change, which Governor Lamont convened in 2019 and has been tasked with recommending strategies to reduce carbon emissions and also helping our state to adapt to the impacts of climate change. Here in the state, I know in part because of the leadership of legislators like yourself, Senator Lesser, we have new requirements for the incorporation of sea level rise in planning for keeping communities safe during major flood events, such as those that we have seen in Florida and Puerto Rico. And we also have invested with our flagship universities, like the University of Connecticut, in ensuring that we have research partnerships and policy supports for the state and for municipalities, so that we can have downscaled models of real actionable projections of sea level rise and other critical climate indicators to inform our regulatory frameworks and our planning. DEEP is really proud as well, my agency, that we are able to support communities with new types of funding to help them plan for investments in climate resilience. It's very opportune this moment that with so much federal funding becoming available for communities to invest in climate resilience, that we have state bond funds that for the first time are available for communities to hire consultants and do community engagement to begin to envision the types of projects that they want to put forward to build a pipeline of resilience projects that can be competitive for federal funding. We know federal funding for climate resilience has grown by 400%, with more than $49 billion in funding now available from the Bipartisan Infrastructure Law and the Inflation Reduction Act. Those federal dollars have the potential to transform our communities, especially environmental justice and vulnerable communities. And we're really excited to be partnering with communities to help them build up, again, a pipeline of compelling projects to help secure those dollars and bring them into our communities. We know that Connecticut has already been facing the impacts of climate change. We've certainly, over the 10 years that I've been working here at the state level, we've experienced lots of impacts in terms of heat waves, tropical storms, hurricanes, flash flood emergencies, as well as increased significant drought. These are all things that we talked about as projections and now are here as a reality. And so we are, as we're prioritizing investments in keeping our community safe, we are also doing as much as we can to further reduce greenhouse gas emissions across the state to meet our target of a 45% reduction by 2030 and 80% by 2050. And we're joined by many states across the country as part of the U.S. Climate Alliance who are working towards those efforts. And it's really exciting to think about how the Department of Insurance and the insurance industry can play a role in facilitating both resilience and mitigation by helping to value common sense measures that will make that make buildings more resilient and that help to secure the funding that can ultimately also contribute to buildings being more efficient as well. So really excited to be part of this summit and happy to engage in the dialogue today. Thank you.
Thank you so much, Commissioner, and I would love to be part of that conversation going forward. But I had a question about the Governor's Council on Climate Change, which I know you chair and which includes the Department of Insurance and 10 other state agencies. Can you talk about that interagency conversation and how the department is leading in that conversation?
You bet. Well, we know that because climate is touching nearly every aspect of our lives and our economies, it's really important to have agencies working collaboratively together across the state to implement resilience and mitigation measures. I think this whole of government approach is something that Governor Lamont embraced when he established the Governor's Council on Climate Change and included both our Department of Public Health, Department of Transportation, our budget agency, the Office of Policy Management, and as well the Connecticut Green Bank, the Department of Insurance. All of these different agencies have an incredibly important role to play. And it's finding those, the Governor's Council has been really invaluable in bringing expertise from across state government to help inform 60 recommendations that we provided to Governor Lamont in early 2021 for coordinated efforts that could be taken across state government for mitigation and resilience. I'll note that the Department of Insurance has played a really important role on a working group that we established within the Governor's Council. It was specifically focused on how to bring the insurance industry to the table to help finance resilience and ensure that the risks of climate change are reflected in the insurance industry. The Department of Insurance was a co-chair of the council's working group on this topic, and it has certainly informed a lot of efforts, I'm sure, not just within insurance, but in my agency with respect to our work on building codes, and thinking about our collaborations with the Green Bank to think about how we can leverage financing tools that we've historically used for energy efficiency and emissions reductions to also support and value investments in measures that make buildings more resilient. So this is just one example of how we've the collaboration across agencies has enhanced the response that each of our agencies, I think, are contributing to addressing climate change.
Thank you, Commissioner. And as the council has identified climate change hazards, what actions have the legislature taken to address those hazards? Where are we currently?
Well, it's, every session, I think we say, this is the most ambitious session and impactful session for addressing climate change. And I think just because the scale of the problem continues to accelerate, but the solutions are also proliferating, that we continue to see nation-leading legislation passing every year. I'll note it, in the 2022 legislative session in Connecticut, we were really excited to see Governor Lamont's proposal for achieving a 100% zero carbon electric supply by 2040, advanced to the governor's desk, as well as the Connecticut Clean Air Act, which is a really sweeping bill that will help to drive down emissions from the transportation sector, which is one of the largest source of greenhouse gas emissions and air emissions in our state. The legislature has also provided for funding for climate smart agriculture and forestry to help our working lands, our farms and forests become more resilient to the impacts of climate change, as well as to help working lands contribute to a net zero carbon budget. We know that when carbon is sequestered and stored in forests or forest products and soils, that can result in negative emissions that help to offset the emissions we cannot drive down to zero. And on the resilience front, it was great to see the legislature continuing a really innovative streak. First, 2 years ago, the legislature authorized the Connecticut Green Bank to expand its scope to focus not just on energy efficiency and renewables, but also resilience measures and other environmental objectives. And then in the 2022 session, a bill passed that expands the Property Assessed Clean Energy, or PACE, program that's backed by the Connecticut Green Bank to allow businesses to access the PACE program for low-cost financing for resilience measures, which is really, really exciting. So, some of these different, that last improvement, I think, is an example of the kinds of tools that agent or entities like the Green Bank can bring to businesses, to residents, and to the economy as a whole. The demand for those types of tools, of course, will be driven by how the insurance industry is valuing risk and reflecting incentives that encourage property owners to invest in in resilience measures and mitigation measures. So, we're excited about this progress. There's certainly a lot more to do. I guess last one I would note is support for municipal funding sources for resilience. This is another really critical need. We were excited to see governor's bill pass that gives municipalities the option to raise revenues for financing resilience projects through establishing stormwater utilities and municipal flood prevention, climate resilience, and erosion control boards. In a home rule state, that's really, really important to ensure that our local governments have sufficient dollars for matching funds for some of that enormous amount of federal funding that's becoming available to support more resilient infrastructure.
Thank you so much for that. We are also joined, we're very lucky to again have California Insurance Commissioner Ricardo Lara on with us. Commissioner Lara has a long record as one of California's most effective environmental champions. He's passed laws that promote innovation and investment in clean air, embrace equity, protect waters from oil drilling, and keep California at the forefront of confronting global climate change. He wrote the nation's first climate change insurance law to protect Californians from climate-linked environmental disasters like wildfires, extreme heat waves, and sea level rise. And he's the co-chair of the Climate Risk and Resilience Executive Committee Task Force at the National Association of Insurance Commissioners. Hello, Commissioner Lara.
Good to see you again, Senator Lester. It's great to be here with you.
Commissioner Lara, I hear you've got some opening remarks.
Yeah, absolutely. I'm grateful to Commissioner Mays, my good friend, for the invitation to speak today and share my experience as a state insurance regulator. And I'm also pleased to be joined by my co-chair, Commissioner Altmaier from Florida, who's going through a lot, unfortunately. Again, I'm also delighted to be here with representatives from FEMA and the Connecticut Department of Energy and Environmental Protection. Insurance is really an evolving field because it's really centered around risk, which are consistently changing. And how we approach new public policies and insurance regulations really must evolve to meet that challenge, especially in the face of dynamic risks like climate change. And so for years, California and other like-minded states like Connecticut have warned repeatedly that we need to prepare for the impacts that climate change is having on risk and our ability, I should say, to prepare for it. Wildfires, flooding, heat waves really don't respect state borders, and we have to work together as insurance-based regulators of insurance to really tackle this risk that we keep seeing. And as many as you know, insurance in the U.S. is regulated at the state level, and insurance commissioners really set policies that apply to companies operating in our jurisdictions through the National Association of Insurance Commissioners, as you mentioned. And state insurance regulators really coordinate sharing knowledge and experiences from their efforts. This is why we're constantly in communication with our colleagues in Connecticut. This system has really an immense value because it allows individual states to act as test beds for new policies while providing for knowledge transfer to other states. And quickly in California, my department really has been working on prioritizing climate policies to ensure consumer protection and a reliable insurance market in the future. Changes to insurance laws can guard against disruptions to both consumers and insurers. In December 2019, implementing a moratorium law that I proudly authored while I was in the state Senate that protects wildfire survivors from preventing insurance companies from non-renewing policies for those living adjacent to a declared wildfire emergency for a total of 1 year, this law really recognizes it's absolutely critical to give consumers some breathing room after a wildfire disaster. Even if they don't lose their home, they might have lost a neighbor, a friend, a loved one. And so really this action allows insurance companies also a chance to assess, so they're not so quickly willing to drop their longtime customers. And to date, since 2019, I've protected more than 4 million residential policies from non-renewals by insurance companies. And so again, as regulators, our approach to insurance supervision needs to be comprehensive. I'm also proud that I've created a historic sustainable insurance roadmap, working with the United Nations on principles for sustainable insurance, which really outlines key actions that regulators and insurance companies need to take to protect consumers, to create a more sustainable insurance market in a time of intensified climate risk. This would be the first of its kind in the world. And through this roadmap, the department is providing a vision of how to approach innovative risk management and solutions that reduce climate risk and protect our natural infrastructure. And we are, again, the first regulator in the world to have this kind of guide. The roadmap really is centered around 4 foundational strategies. 1, strengthening transparency and financial oversight. 2, accelerate transition to more sustainable investment strategies. 3, really catalyze insurance product innovation to achieve climate goals. And really the last one, which is critical, is create resilient communities. These strategies provide new tools and policies for how insurance regulators really can approach the current and future climate risks. Again, changes to state laws can strengthen climate adaptation because insurance rules and incentives can transcend jurisdictional boundaries. Wildfires have always been a part of California's history, but in the last few years, we have strategically seen new records for loss of life, acres burned, and losses of homes and buildings. And with rising temperatures, extended droughts throughout the western part of our country, and expanding development into wild and urban interface, wildfires are going to continue to increase, unfortunately. And so what I've observed in the last 3 years in California is communities really rolling up their sleeves and taking action to harden their homes and neighborhoods. But the risk can seem complex, and homeowners don't always know what to prioritize. That's why, again, we brought together all these California agencies that have experience in wildfire mitigation, really to come up with a list of home and community hardening measures for insurance. And this work was finalized in the past February when we launched our Safer from Wildfires framework, really providing the public with a consistent approach to reducing wildfire risk, with a list of effective actions that homeowners and businesses can take to really harden their home. And again, these are all critical measures that are important, that we work with the legislature, work with our fellow commissioners to really look at what other states are doing. I would just say in sum, Mother Nature is our best advocate we have on climate change. As you look at the wildfires, heat waves, flooding events, you cannot deny the reality of what we're facing or the need for immediate action. Further reducing risk and closing protection gaps are going to be vital for strengthening our nation's climate resilience today and tomorrow. Thank you again for allowing me to share a few thoughts, and look forward to answering your questions.
Thank you so much, Commissioner, and it's great to have you on again. It's great to see you again. I just wanted to follow up because you talked about wildfires, but I'm curious, having the country just go through a large, almost nationwide bout of heat waves, what do you see as the role for insurance with responding to that kind of hazard?
Absolutely. Of course, of climate intensified perils, extreme heat events are the most deadly extreme weather in the US. Just a few weeks ago in the Western United States suffered one of the hottest heat waves in history. The blistering event set records from Washington State to Southern California and all the way up to the High Plains. Sacramento was hotter than Phoenix. And Ukiah, which is a small town in the Redwoods area, was even hotter than that. And we were all very concerned about blackouts due to the strains on the energy grid, as well as fire from combined heat and lack of water. So currently the cost of heat waves are largely uninsured, and extreme heat impacts fall heavily on our most vulnerable and marginalized communities. Last year, we started taking some important steps, I should say, toward future solutions. In July of 2021, after 2 years of work, my department released the first ever climate insurance report, including a recommendation from our climate insurance working group. The working group included public policy experts, environmental advocates, and insurance experts. On their key recommendations was the need to be able to rank heat waves. So last November at COP26, I announced I was sponsoring new legislation to create a heat ranking system for California. That legislation was signed into law, and now my office is already looking to the next step, of which is to develop new innovative insurance mechanisms to protect communities from extreme heat. And so it's going to allow us to better communicate the risks associated with extreme heat. We can't just treat it as another weather story in the news. We have to rank, collect the data, and along with that, we're going to be doing some research in my Department of Insurance to look at the hidden insurance costs, both uninsured and insured cost to extreme heat. So stay tuned. We'll definitely share what we've learned through our data collection and through how we communicate risk better for our most vulnerable communities around extreme heat in California.
Well, we will anxiously await that, Commissioner. And do you have any other approaches that you think might be of interest to those of us who are in other jurisdictions?
I think, again, further collaborating, Commissioner Mays and I are lockstep in all this work that we're doing. Collaboration helps policymakers learn from each other. Each of these areas are innovative in resilience, and insurance really creates an example that other states and other jurisdictions can draw from. I would just say, a recent major example of this has been the adoption of new TCFD-aligned climate risk disclosure survey. And up until 2020, only 6 states implemented our annual climate risk survey for insurance companies. But the number has grown. In 2022, I could say a bipartisan coalition of 15 states now will be administering the survey in their jurisdictions. Climate issues can be contentious and polarizing, as we know, but we are seeing people engage, I would say, from both sides of the aisle when it comes to climate risk and disclosure. Our international engagement is another cornerstone for innovation. California is a founding member of the Sustainable Insurance Forum, a group of more than 20 insurance regulators, including France, Australia, Japan. And this group is chaired by the insurance regulator of the Bank of England. And so, again, we need to further capitalize on coalition, building our networks. And to say now that the TCFD disclosure survey is going to represent 80% of the insurance market in the country is amazing. I would have never thought we would have been here, but really working on creating those coalitions. And of course, Commissioner Mays has been lockstep with me in growing this coalition of folks. And this is a major accomplishment for us. TCFD aligned disclosure with additional insurance specific questions is what we need. And hopefully now getting the US in par with what is happening in Europe. So it's a very, very big win for us.
Well, thank you, Commissioner, and it's great to get that update, and we look forward to continuing our 2 states' continued partnership on that. And thank you again for being with us. Next up, we have Whitney Welch, who is a grants management specialist with FEMA Region 1 within the Mitigation Division, Hazard Mitigation Assistance HMA branch, where she is the regional point for the Flood Mitigation Assistance Program and supports the Pre-Disaster Mitigation Program and Building Resilient Infrastructure and Communities, or BRIC program. Whitney, great to see you. and had a few questions. Can you provide a brief overview of the FEMA mitigation programs that promote the inclusion of climate change and resiliency activities?
Thank you, Senator. Thank you for inviting me to participate on this panel discussion alongside these amazing partners. Currently, FEMA actually has 5 mitigation grant programs that support the inclusion of climate change and resiliency activities. These include both that you already mentioned, the Building Resilient Infrastructure and Communities, or BRIC, Flood Mitigation Assistance, or FMA program, the Hazard Mitigation Grant Program, HMGP post-fire, and public assistance mitigation funding. The Building Resilient Infrastructure and Communities program is funded by a 6% set aside of the assistance FEMA provides following a presidential disaster declaration. And funding is broken into 2 buckets. So there's a state, tribal set aside, and national competition. For fiscal year 2022, our program priorities include incentivizing natural hazard risk reduction activities that mitigate risk to public infrastructure and disadvantaged communities, incorporating nature-based solutions, enhancing climate resilience and adaptation, and increasing funding to applicants that facilitate the adoption and enforcement of the latest published editions of building codes. The FMA program is a nationally competitive flood hazard only mitigation grant that funds both mitigation projects and mitigation plans with funds annually appropriated by Congress. Now, historically, the FMA program funding source was a fee charged on all national flood insurance program policies. However, for fiscal year 2022, awards will be funded in whole or in part with funds appropriated by the Infrastructure Investment and Jobs Act. Priorities of this program include capability and capacity building activities, which are your project scoping, partnerships, planning, localized flood risk reduction projects, and individual flood mitigation projects, all of which allow for and promote the inclusion of climate change and resiliency activities within their designs. The primary purpose of the FMA program is to reduce or eliminate the risk of repetitive flood damage to buildings insured by the NFIP, and eligible applicants for both non-disaster programs include states, tribes, and territories, while eligible sub-applicants include state agencies, tribes, and local communities. FEMA's Hazard Mitigation Grant Program provides funding following a presidentially declared disaster with the goal of funding projects that allow communities to rebuild in a way that reduces or mitigates future disaster losses. And HMGP post-fire intends to mitigate post-wildfire secondary hazards, such as floods, erosions, and mudflows in areas in or near burned lands following a fire management assistance grant declaration. Lastly, public assistance mitigation is funded under the FEMA PA program. PA mitigation funding provides support for mitigation measures in conjunction with the repair of the disaster damaged facilities. So it is limited to declared counties and eligible damaged facilities, but public assistance mitigation funding is typically applied on the portions of the facility that were damaged by the disaster, but can mitigate the entire facility on a case-by-case basis. So PA mitigation project designs can also incorporate climate change impacts and other future conditions. And eligible applicants for the disaster programs include states, tribes, and territories, while eligible sub-applicants include state agencies, tribes, local communities, and certain private nonprofits. And for more information on any of these programs, we really highly recommend reaching out to the State Hazard Mitigation Officer, whose contact information you can actually find right on FEMA.gov.
Thank you. And can you talk a little bit more about how the passing of the Infrastructure Investment and Jobs Act impacted the FEMA hazard mitigation programs?
Absolutely. So the IIJA, or bill, provided FEMA an additional $6.8 billion to continue to address climate change through mitigation projects by appropriating $1 billion in funding for BRIC and $3.5 billion for FMA over a 5-year period, which has begun with fiscal year 2022. So what does this look like? Well, the recently released fiscal year 2022 BRIC Notice of Funding Opportunity has $2.295 billion available in funding. This is more than double the amount that was available in fiscal year 21. And the fiscal year 2022 FMA NOFO has $800 million in available funding, which is more than 5 times the amount that was available under this program in fiscal year 2021. As both these programs have historically seen total annual sub-applications exceed available funding, we will likely see an increase in the number of projects awarded, which is wonderful.
That is really good news. And you noted that both the BRIC and FMA programs include competitive funding. Can you just discuss how the national competitions incentivize climate change and resiliency activities?
Absolutely. So the BRIC program projects considered under the national competition undergo a national technical review and qualitative review. The technical evaluation criteria offer incentives for elements valued by FEMA, informed by the current FEMA strategic plan. And these include if the sub-application is an infrastructure project, if they're incorporating nature-based solutions into the design, if the applicant implemented mandatory adoption of current building codes, if the sub-applicant has a building code effectiveness grading schedule rating of 1 to 5, and if the sub-applicant has a CDC social vulnerability index of 0.6 to 0.79 or is designated an economically disadvantaged rural community. The qualitative evaluation criteria are narrative submissions, which allow sub-applicants the flexibility to fully explain the strengths of the proposed project. And scoring criteria includes the incorporation of risk reduction, resilience effectiveness, climate change and future conditions, implementation measures, population impacted, community engagement, and other outreach activities and leveraging partners. Beyond priorities and scoring, these programs actually allow for the inclusion of climate change considerations, such as incorporating sea level rise into designs for coastal projects, utilizing modeled damages for increased precipitation events, and expanding and updating ecosystem benefits within the FEMA benefit cost analysis tool.
Thank you so much.
Thank you.
Lastly, we are joined by Florida Insurance Commissioner David Altmaier. David was appointed as the Florida Insurance Commissioner in 2016 by the Financial Services Commission. He leads the Office of Insurance Regulation, or OIR, and his oversight over one of the largest insurance markets in the world. Under Altmaier's leadership, OIR has worked to cultivate a market in Florida in which insurance products are reliable, available, and affordable. And he is taking a lead in responding to the effects of Hurricane Ian.
Well, good day. Thank you for having me here, Commissioner Mays. It's always a great opportunity to share some of the insights from Florida. I certainly appreciated being a part of this conference last year and looking forward to being a part of it again this year. So just want to say thanks to the Connecticut Department for the invitation. I'm David Altmaier. I'm currently serving as the Insurance Commissioner for the state of Florida, the Sunshine State of Florida, as we like to call it. And I thought what I would just do is share a few insights of some of the things that we've got going on down here, much of which we've been working on all year, a lot of which has been re-emphasized in its level of importance after the landfall of Hurricane Ian from a couple weeks ago. Hard to believe it's already been almost a couple of weeks. Let me kind of start first with our property insurance markets. You've likely seen a lot of media attention on our property insurance market, especially in light of Hurricane Ian. But our property insurance market has been challenged for a number of years now. We've got significant challenges with respect to the affordability of insurance products. We have significant challenges with the availability of insurance products in the residential property insurance market. A lot of this is driven by a variety of factors, one of which is we've unfortunately had some elevated catastrophe activity, with Hurricanes Irma and Michael being especially devastating to our property insurance market. Hurricane Ian will add to that disruption, I'm sure. But those elevated catastrophe losses have hardened the global reinsurance market, which our domestic industry is very reliant on. So that's introduced challenges. But we have also had just some historic challenges with excessive litigation. And all of that is exacerbated by the heightened catastrophe activity that we've had. So our property insurance market has not been profitable. In fact, they've lost a couple of billions of dollars on the underwriting side of the house over the past couple of years. So we're seeing a lot of insurance companies that are withdrawing from our market. So far this year, we have already had 6 property insurance companies become insolvent. And we've seen the companies that are remaining in our market express a need for some serious rate increases. We've been approving rate increases anywhere between 30 and 60% this year. So obviously not a good situation for consumers. The good news is that through a series of legislative reforms, including most recently during our special legislative session back in May, the state of Florida has taken some pretty considerable steps to address a lot of these challenges. We've been focused on the excessive litigation that we have in our market. Just to put that into context, in 2021, Florida had approximately 8% of all homeowners insurance claims in the country, but Florida also had approximately 76% of all of the suits filed against homeowners insurance companies in the country. So obviously significantly out of proportion there. And so that has been the focus of our attention legislatively over the past several years. In 2019, we passed House Bill 7065. In 2021, we passed Senate Bill 76. And most recently, as I mentioned in our special session in May, we passed Senate Bill 2D. All of those things, as I mentioned, look at the way that attorney fees are paid in the state of Florida, which we think is one of the driving factors for the litigation challenges that we're having. And it's the first time, I think, in our state's history that we have actually addressed the issue of attorney fees, which I think is going to make a meaningful difference going forward. Already in 2022, we've seen almost a 25% decrease in year-over-year litigation against insurance companies, which I think is very positive. I think there's still more work to be done. And so I'm looking forward to next year leaning into some of the legislative momentum that we've had to continue to take some steps to shore this up. Also, it's going to take some time, even though we've seen some good initial results from this legislation. It's going to take some time for that to start making its way to the balance sheets of insurance companies into the pocketbooks of consumers. But we're going to continue to stay very diligent as we continue to work on that. One of the things that Senate Bill 2D also reauthorized, it was a program that was already existing and it was just simply refunded, is the My Florida Safe Home project. This is going to provide some funding for consumers to focus on resiliency efforts for their homes. And so there's now going to be some funding. If you qualify, it'll be administered by the Department of Financial Services here, where consumers can actually get some funding to help mitigate their homes against future catastrophe losses. And between that and a bill championed by CFO Petronas that allows some tax incentives for such mitigation, I think consumers now are going to have some incentives to look at ways that they can shore up their homes and that we can shore up our communities to be more resilient in the face of natural catastrophes. I'd be remiss if I didn't take a few moments and talk a little bit about our experience so far with Hurricane Ian. As I mentioned, it made landfall in around Fort Myers, Florida, which is in the southwestern part of the state, a few hours south of Tampa, as a Category 4 hurricane, a very strong Category 4 hurricane, and brought with it just a historic level of storm surge. And it came ashore on September the 28th. And since then, I'm sure you've seen the media photographs of the area that was impacted. It's just been devastating for the community, not only from an insurance standpoint, but obviously just from a disruption in everyone's way of life down there. So the entire state government has been in and around Fort Myers and Port Charlotte and other impacted areas as we have looked for ways to expeditiously put everything back together down there. I've personally been down in the area. Most of my staff have been down in the area, and we have a considerable number of staff that are still down there assisting consumers with insurance information and just about everything else that folks need help with. The office is collecting claims information on a daily basis. As of yesterday, we were around $4.2 billion in expected losses just from claims that have been filed so far. So we expect that number to get significantly bigger. A lot of the modeling firms are estimating anywhere between $40 and $60 billion in total losses. Some are even higher than that. And so this will be one of the costliest natural disasters in all of the country. One of the challenges that we anticipate twofold. First of all, as a Cat 4 storm with such significant storm surge, there's going to be a lot of wind versus water discussions when it comes to claim time, and sorting all of that out when there's not much left of a property to adjust is going to be challenging both for our direct writers as well as for the NFIP and the private flood insurance companies that we have writing down here. So we're going to be working through those issues. I'm sure we've got some experience with that after Hurricane Irma, and obviously some other states that were impacted by storms like Hurricane Katrina have gone through that as well. The other thing that we're going to be working through is, unfortunately, you'll read, as we do after most significant flooding events around the country, a very significant number of people who either did not purchase flood insurance or did not purchase enough flood insurance. And so we will be helping those folks as much as we can, but continuing to reiterate to everybody in Florida that even if you don't think you are at risk for flooding, you should still explore with your insurance agent buying flood insurance. And we like to joke here, it's not much of a joke, but we like to say that if you pull out your driver's license and it was issued by the state of Florida, then you need flood insurance. And so we're going to continue to double down on that messaging and hope that we can continue our efforts in closing that protection gap. Long term, we expect that this will be a significant event for the global reinsurance market as well. And so we expect that market conditions in the reinsurance community will continue to harden, which will make the impacts of this storm a little bit more long term in nature as our direct writers go back out into the reinsurance renewal cycle. And so we've got a long road ahead of us with respect to Hurricane Ian recovery, but we've got all hands on deck all across state government, and we're looking to get into the communities and get that put back together as quickly as we possibly can.